All right, everybody. Hello. As you can see, we're here for business tonight. That's all I gotta say.
Got the
There's
hater
been a
blockers
lot of
on.
there's been a lot of stuff going down this last week that we can't let slide. So in 30 minutes here, Dividend Dude is going to be gracing us with his presence. Um, what kind of presence? Well, you'll have to watch to find out.
Christmas presents, perhaps?
Yep, you never know with our channel. Speaking of our channel, before we get into the stream, make sure to subscribe, share the channel if you haven't already. We're trying to hit 50 subscribers by end of month. I think that's very doable. So we need 20 more. So share the channel. We'll get the more people in here, obviously, the better. So can you do that? Fiscal, where can the people find you?
In the same place, down in the description, baby.
Yep. Always links are always in the description. We've
Always.
had this has been an eventful week.
It has. It has.
We got buys, sells, Dividend Dude calling our stock cigar butts. There's a lot going on.
Yep, falling knife, cigar butts. That's what's going on. So, I think one of the ones I want to maybe go over a little bit is Intel.
Oh boy.
So, have you heard about their new spinoff they're thinking about doing?
I have not formally looked into it.
So, have you heard about their programmable chip business?
Yes.
Okay, so they announced very recently that they're planning on doing a spin-off and IPO of that part of the business. Do you remember Mobileye?
Yeah.
So kind of like that, where it seems like they'll probably keep controlling interest of the company, but IPO a bunch of it to raise cash, basically. Now, I think, considering the time frame, now they've announced it now, but it's not happening like in the immediate future. Can we agree right now is probably not a great time for an IPO?
Yeah, I think with Intel's healthy and competitive business structure, quote from Pat Gelsinger there, I don't think now is the optimal time, we'll say.
Well, the market isn't really loving IPOs right this moment, right? So they plan on doing it, and they kept it pretty open. 2 to 3 years in the future is what they're saying.
Okay.
So
2 3 years. That's
yeah,
medium.
I think it's good keeping it a little bit open like that, so that they can, maybe time it at a time when maybe they can actually get, if they're doing it to raise cash, they should really be doing it at a time where they can get a premium for that division of the company. I think they probably spun off. They IPO'd Mobileye at like the worst possible moment, if I had to, think about it. And they didn't get all that much for the portion that they IPO'd, from what I remember. It was like, what was it, like $1 billion that they got?
It was not a sizable amount, let's just say.
Yeah. Like not even a dent. Like they couldn't even build one fab for that.
Yeah.
Yeah. So in my view, that was kind of a squandered opportunity. If they had just waited for the AI bubble,
yeah. They may have missed the train on that one for sure.
Yep. So that's kind of what I'm watching. I mean, Intel went up a little bit when they announced it, but I mean, it's kind of more or less flat. Honestly, I'm not really looking for any big news stories to turn it around, just looking at them to execute on the plan.
Well, let's hope that goes through, because Intel, obviously, I feel that's a long-term play for sure.
For sure.
You guys can call it cigar butts all you want. Cigar butts, falling knives, half open Funko Pop boxes, whatever you guys want to call it.
Hey, I was down like 40% or something on Intel after they cut the dividend, and I'm showing green on that thing today. So like between the dividends, the options premium, and the price appreciation, I'm actually okay. And I think in the long run, I'll be even better, baby.
I want to talk about Pat Gelsinger.
Okay.
I know we poke fun at our boy Pat Gelsinger a little bit for talking about his healthy competitive dividends. But from your perspective, what do you think is his biggest weakness and his biggest strength? Because I kind of have my own 2 cents from my research that I've done.
So, he reminds me, like, he's kind of a geeky guy. in a
I know.
sense.
I know.
He strikes me like he really like he gives me like those. And I'm not saying he's exactly like them, but he gives me like the Bill Gates, Steve Jobs vibe of being like a geeky guy that's legitimately into the technology side of
Yeah.
things.
Yeah.
But with that, I don't think he's maybe necessarily as wise when it comes to the financials.
That's my
Yeah.
sense.
But I think Intel has been, under the thumb of the bean counters for a little too long, and it's killed their innovation. And I think he's more on the innovation side and less the bean counter side. And I
Yeah.
think good companies during different times they need each
Yeah.
thing,
They need a
right?
mix balance.
Yeah. Yeah, they need the bean counters to kind of hold the dreamers in check to an extent, and they need both for sure
Hmm.
in the long run. So I think right now is the time when Intel needed a Pat Gelsinger, the geeky technology, enthusiast, more so than it needed the bean counters. The bean counters, they don't have enough vision to really see the future, and right now Intel needed somebody that could see some future.
Yeah. I could be wrong, but I'm pretty sure he started his career with Intel. I could be wrong, but I'm pretty, at least from his early stages. So, I mean, I think he definitely is like, as you mentioned, like, I don't think financially he's the greatest CEO, like, whatsoever. And that's where I
Yeah.
think maybe other, leadership might need to kind of step in and,
Yeah. I mean,
be
I don't
kind of
know
the
much about their
sideline coach to the
CFO.
head coach and hold him back from all those capex.
Yeah. I mean, if they have a good CFO and a good board, to maybe keep him in check a little bit, not
Yeah.
let him do anything too outrageous, I think you can strike a good balance.
$8 billion isn't that much.
It's 8 billion too much.
Ah. Oh, okay. I want to talk about a company, and this is a little spoiler for this week's buys and sells segment that we're going to be coming out with on Monday or tomorrow probably. I may or may not have possibly trimmed some of my 3M.
Really?
This is a very slight trim, and I reallocated the capital.
Okay.
3M right now is a company where I feel there could be opportunity cost if I were to potentially trim. So I may or may not have sold off my dividends like that I've reinvested back into the company so far. Most of those I found have been reinvested back at $190 range, so I wouldn't be selling out at much of a whole loss. And I put the money into Vici. I bought 2 shares of Vici with that capital. And I think Vici right now is relatively, I have higher margin of safety, lower volatility, and lower risk, I think, long term.
Is Vici still below 30?
Vici, I got it at 28.
Not bad. Not
Yeah.
bad. Not bad. I mean, I'd buy that for $1. I'll just say that.
What, Vici?
Yeah.
You don't like it?
No, I mean that's a euphemism. It
Oh,
means it's a good thing.
okay, good, okay. Yeah, trimming 3M, I'm probably going to, I don't know if I'm reinvesting my dividends or not, but I mean, there is a lot of risk, and I do see a lot of other opportunities right now in positions that I don't feel like putting, wasting a third of my capital on either way. Vici's a cigar butt. We can't win.
Yeah. Well, Vici they have an interesting property type being, casinos. I think there is a little bit of risk in being fully concentrated in one property type. But if you think the long term is good for that particular property type, then I think you'll be okay.
Why not sell out if you're willing to trim? The part that I trimmed, I'm selling out at much less of a loss than if I were to sell out of my entire position right now. If I were to sell out of my entire 3M position, it would probably be a 30 or 40% loss right now, where it's like a 3 or 4% maybe with the dividends that I sold out of. So, and I do still kind of hold true to my 3M investment thesis. Like if you look at their revenue, it's still generating crazy revenue, but it's more the
I
free
mean,
cash flow.
it sounds like you didn't really trim much, and it seems like more or less you just wish you hadn't dripped the last couple quarters, and
Yeah.
you're just reallocating that portion.
Yeah.
Yeah. I mean, Yeah, that's basically like breaking even on what you dripped the last couple quarters, and you've turned off dividend reinvestment on it going forward.
I believe it. Yeah, I think I
Okay.
have.
Yeah, I mean that makes sense. You don't want any more 3M, and you're happy with what you had previously, and you're just willing to keep it there. Make it a
Yeah.
smaller allocation.
Yeah.
I can see that. I can see that. Um, I mean, you were in good shape, getting a little bit of a bump, I think, from the lawsuit settlements.
Yeah.
Did you sell around that time, or was it more recent?
No, it was on Friday.
I gotcha,
So it was a bit of a low, but I mean,
gotcha.
I think
Not bad
Vici is relatively undervalued. I have a fair price, $33, $34. So
for Vici.
yeah.
Hmm. Yeah, I mean it's last I saw, the valuation wise, the market seems to price it similarly to Realty Income. When when you when you look at like the premium to net asset value, yeah. So
Yeah.
the market seems to think it's equivalent quality to what I think many people view as. I mean, a lot of people view O as the symbol of quality in the REIT.
Yeah.
Yeah.
I mean,
So
I think there's more growth to be had, at least right now, with Vici. Like when it comes to like AFFO, I mean, they're obviously
yeah.
much younger company than
Mhm,
Realty Income. Realty Income, you're guaranteed pretty much to get a
mhm.
3-4% dividend, hike every year, and their AFFO per share is
Yeah. So Realty Income, you get a lot of diversification. That's like kind of their selling point. But with Vici, you have, I think, something that's pretty recession resistant. Like I think the kind of people that frequent the casinos are going, whether the economy is doing great or doing badly in a lot of cases.
I agree.
It's a similar thesis to like why, maybe Altria is good, because people are still going to smoke and vape no matter what, right?
Hmm.
I get the same vibe from Vici. Plus, their rent escalators, from what I was reading, are mostly CPI based. You can correct me if I'm remembering that wrong, but that would mean that each year they increase the rent based on CPI, not based on a fixed amount. Whereas Realty Income does like a 1% rent
Yeah.
escalator, which that's a pittance, and that's the reason why their dividend increases have been so pitiful last few
Yeah.
times. So yeah.
Yeah, just because the falling knife doesn't mean you got to call its dividend increases pitiful. All right. All right. In all
Hey,
seriousness, though, if you had, if you had to pick one REIT between Realty Income or Vici, which one would you choose? Next 30 years.
I think I'd lean towards Vici. I made a video on Vici a while back, and that was the conclusion I came to. Um, I just I like the type of property they're in, and I also like the fact that their rent escalators are a little bit better. So even if interest rates are high and it doesn't make sense for them to borrow money to buy more properties, they can still increase their funds from operations with rent. Because why are interest rates high right now? Because of high inflation, meaning high CPI, meaning higher rent increases for
Yeah.
someone like Vici. So yeah, but for what it's worth, a lot of REITs have CPI rent escalators, and if the tenants can't make those, I mean, it can be a little bit tough for sure.
Is retail dying?
Well, it doesn't look good for retail right now, but people have tried to declare retail dead before.
Indeed. What are your retail plays? I know you got Walgreens and CVS. Wait, do you?
No, I don't. I don't actually have any CVS yet. I don't think.
Okay.
Yeah, I think Walgreens is like for actual like retail, pretty much it. Like there's a lot of, I mean, Target is, I'm going to say, definitely on my watch list. I forget what my watch list price was for them. Actually, I think it was like 120 or something, and we fell below it a while ago, and I just didn't notice. Um, but yeah, I think Walgreens pretty much is the biggest retail thing for me. I mean, I don't know. Do you consider Baba retail? I mean, it's kind of e-commerce, I think,
Yeah,
more
I'd
so.
consider that more. They have much more online presence.
Yeah, I mean, I've got a REIT that Global Net Lease. They have some retail. in there, I think. I mean, but it's less
everybody's
than 1%.
attacking the Walgreens play. The chat doesn't like it.
Yeah, I know chat doesn't like it. A lot of people don't like it, but I mean, let them not like it. I'm the one that's got to live with the red in the portfolio, not them. So,
oh, that's kind of sad. I'm the bad guy. You need somebody to point your finger at and say that's the bad guy. You're turning into the Scarface of value investing.
Turning into Tony Montana, huh?
Yeah. Come on.
I'll bury those cockroaches.
I want to talk about NextEra Energy because we're going to talk about that with Dividend, dude.
Okay.
There's been a lot of slander regarding the clean energy utility, as some would say. It's fallen nearly 20% this week.
I've read a little bit.
Yeah, it's a very easy time to look very negatively on the stock. I'll say that. They have a lot in debt, and it's not being favored by the market really right now. But I will say this: Chuck from Fast Graphs is looking at it. So if Chuck's looking at it,
I do like Fast Graphs.
Chuck's the man, though. So is NextEra Energy. I want to hear your thoughts overall on it because it's not often you see a utility drop 20% in a week.
So are they 100% wind and solar, or
they sold off one of their gas pipelines, I believe, this week.
Yeah.
So
okay. So when it comes to, I mean, I don't think I have anything that could be considered a utility unless you consider, I guess like Comcast and Verizon have utility-esque attributes, but I don't have any pure utilities like electric, gas, water.
Yeah.
I've heard high interest rates are hard on utilities because they tend to have a lot of like CapEx, a lot of leverage potentially.
Yeah. I'm going to get to this. NextEra Energy, they have $70 billion in debt.
Yeah. Okay.
It's a little bit.
So I guess the problem is like when it comes to electricity in particular, wind and solar, it's great that they don't burn any fossil fuels, but maintenance on wind turbines, from my understanding, is expensive. And solar loses its efficiency over time, and constantly need to be replacing panels, etc. Honestly, I think in terms of electricity, I think nuclear is actually where the future should be headed. I just don't know if humanity is intelligent enough to get there. But I have a hard time investing in what I think are a bunch of, pointless and obsolete types of power generation. Like coal, I think coal is definitely out of favor. Everybody's doing everything they can to move away from coal. So I wouldn't invest in that. Renewable, though, I think has a tendency to have like elements of being a bubble as well. People
especially a few years ago.
Green. Yeah, you remember everybody said everything was green all the time.
And especially with like the Biden administration getting in.
Yeah.
Like that was the craze.
Mm-hmm.
Yeah. So I want to talk a little bit about it because I have a pretty small position in NextEra Energy. And I'll admit here, like straight up, like I do regret it or buying it mainly. I kind of got into that over diversification trap. But at the same time, I'm in like the middle zone where like I don't want to sell at the bottom, but I don't want to sell at the bottom. But there's also like a bull thesis for me too. Like in the case that it's a utility, there is a very good chance that all these capital expenditures are making over long term. They do pay off. They have a very strong track record when it comes to performance. Obviously, that $70 billion in debt is bad, but I think utilities have a tendency to possibly, get away with some of that at times with government relations. Yeah. So I'm in the middle, like truthfully. I hate to sell out of a company to 35% loss, but and yeah. I'll be honest, like utilities are hard to understand, and I'm trying to do a better job of staying inside like my circle of competence.
So the one thing to understand with utilities is a lot of like what they can charge, like the money they can bring in is it's a lot of it is just straight out set by the government. Like when they build a new project, a new, capital expenditure, they're allowed to profit 10%, I
Hmm.
believe is the number. The problem is that they actually make nothing on maintaining it after it's built, and that
Yeah.
can be a big issue. And I think there's some rules around, like, for example, what they could charge per kilowatt hour in most states anyway.
Yeah.
I think in Texas it's just wild wild west, like they can do pretty much whatever they want. And you saw how that turned out during that ice storm that was really horrible apparently, for a lot of people. So yeah, but for the most part, yeah, utilities are pretty heavily regulated. So like there's that element of like, well, the government's really heavily involved in what they're doing and guarantees them X, Y, and Z.
Yeah.
And to a certain extent maybe they're subsidized and things like that. But I wouldn't necessarily expect a market beating return from most utilities. I think it's one of those things you get into because it's like, hey, the electric company's not going anywhere,
Yeah.
right?
It's a state.
Yeah.
Yeah, I talk about it. I made a Coke video. It's
Mhm.
coming out next week sometime. And it's like you're not investing in Coke to outperform the market. You're more investing for that stability. If you're older, that, dividend income, Coke isn't going to be going anywhere. Just
Mhm.
consistency overall.
Yeah. And they'll probably do modest, like most utilities will probably do modest raises over time, right? And that kind of thing. But
Well, with NextEra Energy, it's weird because they actually have really like quality, dividend growth at least. So I mean, I think that's probably another reason why I've held on to this point too. But with that $70 billion in debt, it's like, ooh,
yeah, I mean, what I would, I guess, recommend while you're weighing your options is to look at you should be able to find it in the investor relations. And if you look through the reports and things, the debt maturity schedule, and,
yeah,
see how much of that debt comes due and how soon. Like, people always want to criticize Verizon for the debt. But when I see a huge chunk of it maturing in like 2052, I'm like, okay, but that's an awful lot of time, and a lot of that is very low interest. Like it's not like they're facing a giant debt cliff of having to refinance all of that debt in the next like 4 or 5 years or
yeah,
anything, right? So that's something to take into consideration. If the maturities are pretty well spread out over a pretty long time, it may not be that bad of a problem for them.
yeah. And I would assume they get a lot more, as I kind of mentioned, like lean way with the government too. So I mean, I'm weighing my options.
Yeah.
I don't want to sell out at a
I
40%
mean, you could
loss.
probably take your time. I mean, utilities usually are kind of slow movers anyway.
Yeah,
Um,
not this week.
yeah, sure. This week aside, it just,
Yeah.
but yeah, it's like for sure it's not going to zero. So at least you've got that. It probably will
So don't
continue.
somebody don't clip that.
Hey,
We're gonna
and
cancel.
if they keep growing the dividend, hopefully the market just catches up and the valuation matches at some point.
All right, we have world's nicest man, Steve from Cars Simplified, stopping by. Hello, Steve. Enjoy your trip in Ireland.
Our best buddy, enjoy Ireland.
Yeah.
Have a Guinness for me over there, please.
Yes, lad. Utility of moving crap. All right, that type of language isn't needed on the stream.
He said the C word.
Yeah, that's
I'm so triggered right now.
the type of stuff that gets you banned.
Stop
Ladies and
triggering
gentlemen,
me,
we have
Gordon.
5 more minutes till Dividend Dude gets in the stream. This will be great.
Oh, Ish is about to blow up.
Yeah, railroad. I mean, railroads are. I'm also eyeing UMP. I like it at 200. You can't go wrong with it. I mean, you want to buy during cyclically low times, so
They have a moat.
they do it. Speaking of moats, Fiscal made a very in-depth video since some of you guys struggle to understand what a moat is sometimes. It's one of the most referred topics on the channel. So after this stream, go check that video out.
Definitely.
Yeah. AT&T.
Oh Lord, who
Yeah,
wants to talk about AT&T?
yeah. Who
I mean,
wouldn't want to talk about AT&T? I think that's the real question.
I mean, do you remember the commercials with the lady? She was pretty attractive. I mean, that's the only thing I really remember about them.
Indeed.
Yeah, everybody had a crush on the AT&T lady, right?
Yeah, that's how you. That's clickbait for you right there. Get
Exactly.
all the creepy 40-year-old men clicking on the videos.
Whoa, I feel personally attacked.
Hey, hey, yeah, you're hitting your glory years. I can't.
I mean, I haven't hit 40 yet, but like I'm close enough where I refrain from insulting anybody for being 40.
Yeah. Well, if you're cigar butt investor, that's I'm sure what the people have to say.
Indeed. So, AT&T, well, I've really avoided AT&T for the most part. I've looked at it a couple times and I just cannot get there.
Hmm.
So, the first time I looked at it was before the spinoff of the Warner Media, right?
Yeah.
And at that point, it was like, oh, this could be interesting, partly because of that part of the business being there. I think getting rid of it and sending a bunch of debt with it, I mean, they got rid of 40 billion out of like 300 billion or something. And so they still look like they have way too much debt. And they just got rid of one of their highest potential divisions to do so.
Yeah.
And to me, it's perfectly reasonable why it's done nothing but drop like a rock, and it's hot garbage, and I'm going to be avoiding it.
Yeah. Me personally, I'm not much of an AT&T guy. I will say though, when I started, it was very easy to get
Yeah.
AT&T the trap. Because in your head mathematically you'd go 8% dividend
Yeah.
yield.
No, I've had investors sit there and tell me that AT&T is a safe, it's a safe, like guaranteed 8% or whatever
Yeah.
back then. And it's like, well, they did the spinoff, they cut the dividend, the stock fell. Like, no, your return would be garbage if you had gotten in then. So yeah, I think that's like, it's easy to see it and fall for the trap because everybody's heard of AT&T. They seem like a big stable company. Now, if you're wanting a telecom, like you can, there's two of the three, like you can make an argument. Verizon, because of the reputation of having the best network and being so heavily invested in 5G.
Yeah.
And then you have T-Mobile, who has much more of like an international presence. I didn't even realize this. Somebody I work with was telling me about it. And honestly, lately their network has come up to par with Verizon.
Yeah.
But going forward, Verizon will probably take the crown again on the network stuff because of, like, if you look at who invested the most in 5G spectrum, Verizon like eclipses AT&T and T-Mobile put together from what I remember. It's
Yeah.
outrageous. So, I happen to choose Verizon. Like a lot of people stay away from telecoms altogether because of the debt. Totally understand that, totally respect it. It's a small position and I'm satisfied with it.
We have another world's kindest man, Frank, in the chat as well. Everybody, the man, the myth, the legend is about to be in here.
Whoa.
Drop your topics for debate, discussion. We'll list them off. This is gonna be good. I do have a few bones to pick myself, frankly. So I think without further ado, we'll let Dividend do it in here. Hello, Dividend,
Hello.
dude.
Hello, Ryan. Hello, Fiscal.
Hello, brother.
What's good, guys?
Not much.
All right. So, what's the bone to pick, Ryan? What's the multiple?
I think it's more than one bone to pick, buddy. We got following the cigar butt knives to be talked because there's been a lot of slander I've been hearing towards me and Fiscal. Start off, I want to talk about Target. You have been quoted to say that Target is a trash company before. What makes Target what makes Target a trash company rather than an okay company, which I believe okay/good?
I think good is a little bit far. You know, I mean, it's okay.
Good is B tier. Good is B tier.
I guess it's okay. I would put it like C or D tier. I mean, you know, if you look at the stock price along with the economics, it's followed it, right? Their free cash flow's dropped. The revenue's been kind of stagnant. Low margin business, a lot of theft, shrinkage problems they're dealing with, and they're like one in a dozen for retail. I mean, Target's not a great company, you know. I mean, it's an okay company. I think it can recover for sure, but I don't.
So,
I don't see it as
would you say Walmart is a better company than Target?
I'd say they're both kind of in the same avenue. I mean, I'd actually say probably Target's actually better than Walmart. I think Walmart has very slow growth ahead of it.
I think we found common ground, guys.
Yeah.
The beef might be squashed right there.
Yeah.
We all agree that Target's better than Walmart.
Finance beef.
See, that's why I should be a mediator. I always find the common ground right away.
Yeah.
I mean,
that and our despise for sexy red.
I mean, she's not the best.
Not the best.
No, so I guess the problem I have with that is like I think Target serves the bougie class, you know, the people that are just a little too fancy for Walmart.
Half the population.
Yeah, I think they've got an interesting place in the market, and I mean, I haven't looked comparatively between Target and Walmart. Well, what's Target? Since you guys have talked Target's margins, what's their bottom line margin?
Bottom line
on like what's a normal bottom line margin for Target? Like take out any kind of crazy outliers, you know, if they temporarily went negative or something.
I'm looking for 2020 or 2019 because 2021 was kind of a fluke year. All right, margins, bottom line. We'll go. Let's see, 10-year.
I think it's like I think it's like 3%. I could be wrong.
I'm getting
sure it's 3%.
3.5% to 4%.
Yeah,
a little bit higher.
I mean, Walmart, I believe, typically runs around 2%. So, like by retail standards, Target's actually pretty good in that area, right? Mm-hmm. Like you can't just criticize it for being a low margin business without taking into account what kind of business it is, right?
Okay, yeah, but in general, if you're looking at the whole stock market, Target's a low margin business. I'm talking about the whole stock market.
Apples here.
You don't, yeah. Wait, but when you're investing, you don't have to just invest in one retail, one utility, one industrial, one this. You want to invest in the best. And I don't like low margin businesses, and there's certainly better margins amongst retail. So, you know, retail, in my opinion, is one you would allocate less percentage of your portfolio to. So I say overall, it's a low margin business.
Okay. What do you think about Amazon?
Amazon. I love Amazon. Amazon's great. I want Amazon.
Hey, Ryan, why don't you pull up Amazon's margins real quick?
Well, Amazon. There's certain things going on with them right now, you know.
I'm just saying, right? I'm just saying, right? Like, if you're gonna make, you got to be internally consistent with your rationale, right?
Yes.
I mean, you can say that, you know, you don't. You can say there's things you don't like about brick and mortar retail, but you can't say like, oh, well, their margins might be good for retail, but I don't like retail overall because of the margins. But I love Amazon, even though they have margins that are as bad or worse than retail.
No, Amazon's more than a retail business, though. They're way more than a retail business.
But what are their margins and what's the majority of their revenue?
Well, right now they're not good, but before they were profitable, and they could definitely be profitable in the future. They have a lot of value in terms of their brand and what they do for consumers and sellers, and that's going to show in the next 10 years over a company like Target. I understand what you're saying, but
the same, it provides value for consumers.
Yeah, it does, but I don't think it provides as much as Amazon. I mean, a lot of retailers provide the simple value of going to a store and getting a pack of gum or something. I mean, you know, there's different experiences in the different stores, but Amazon definitely is a better business than Target.
They're certainly a bigger business. I don't know if bigger is always better. And if your objective is to, you know, get a better than average return over the next 5 or 10 years, I think at the current valuations, Target's a better deal right now than Amazon. I think, you know, that's a value proposition though, right? Because Target has a pretty like consistent bottom line most years. And right now, I think they're trading at a discount to what they've proven in the past that they can produce pretty consistently. Recent issues are why it's cheap right now. And if you think recent issues are temporary, that's the reason to average in at a lower price.
Yeah, I think Target's going to recover. I don't think they're going to like stay down and just like keep getting worse. I think they're going to recover.
So
But
why
saying
do
they're
you
gonna,
think it's terrible? Why do you think it's CD tier?
I think it's CD tier because I don't think it's as a good retailer in general. If you look at their revenue, it's been stagnant. Their free cash flow over the past years has decreased, and I don't. Even if you look before
The revenues,
the hike, if you look before the hike in 2021, it stayed about stagnant. I don't think it's going to get much better. It's not going to get much worse, and it's going to, in my opinion, underperform overall. I don't think it's a great retailer. I think if you're looking for like a great retailer with less issues, there's companies like Costco out there. So, and companies like Ulta, which are companies I prefer a lot more.
Who owns those stocks? All right. Since Target has deteriorating revenue, I figured I'd bring up the revenue. Obviously, revenue isn't free cash flow is the ultimate metric at the end of the day, but I thought we'd bring up the revenue because it's declining.
I didn't say declining.
I thought fake news. So,
I didn't.
three-year CAGR of 15.59%, 5-year CAGR of 12.21%, and a 10-year CAGR of 7.78. Now in those like 2013, that's like 10 years ago, but like that looks respectable to me. We can pull up the free cash flow for the heck of it. I can see, I haven't done like a deep dive into why they had that decline in 2019, but I mean, it's long term, it's still trending upward. And if we can look quarterly, that's the free cash flow per share in 2023 at least. That's around $5-6 a share. So that's like right here, right now, and they still have another quarter left. So if they can get there, and then hopefully, even with the issues they've been dealing with right now, I still think it ain't bleeding free cash flow. That's what I'm saying.
I mean, it did last year.
It did last year, but is it still?
No,
yeah,
I mean
that's
right
that's
now.
an outlier though, right? That's not the norm for them, you know. I think when you evaluate something for like we're talking, if Ryan's looking at what he wants to own for the next 40 years, if he penalizes every company that's had one bad year in like 25 or 30 years, he wouldn't own any stocks. Like, I mean, 25 years ago, Apple looked like it was going to go bankrupt, and now it's the invincible company with the biggest moat. You know, even the biggest, greatest companies can have years where things don't look so great.
Yeah,
and
I mean, I agree with that.
I think Target's in a situation like that. And I'm not saying Target's like Apple, you know, but I don't think anything that's going on with Target is going to take them out of the game or stop them from generating good shareholder value going forward.
Yeah, I agree with that. But you know, I think there's better options than Target. I mean, you know, Target's not the
unless you've picked the one stock that's going to get you the absolute best return ever in the whole market. There's always a better option.
Yeah, but if you look at like different retail businesses, like if you pull up Ulta, they're doing way better than Target in terms of revenue, consistently growing free cash flows, and they have also had a major dip and traded a similar valuation to Target. So I mean, you know, it's not like there's like worse options. There's definitely better options in retail than Target, and I don't prefer retail too much over like other types of industries. Like I only have one retail company right now, and
Yeah, I mean, ultimately, like when it comes to Target, I view their main competitor, like in the same kind of niche as them, to be Walmart. And I think Target's got more room to have upside and generate more shareholder value than Walmart does at this point.
Yeah, I agree. I agree 100% with that. Walmart is horrible.
You know, I think it's harder to compare Target to like, I don't know, Costco.
Yeah, we got to go apples to apples here. Like,
yeah.
Can you compare Target to like I don't know, something like maybe TJ Maxx or Kroger?
So it's difficult because TJ Maxx is more specifically like clothing, which Target does have, but then Kroger has mostly grocery, which Target also has. So it's like they seem like they're in slightly different categories. Like Kroger is more comparable to something like Albertsons, which they were gonna they were going to acquire. I don't know what happened with that.
And
but
Kroger's much more like essential than Target. I'm not saying Target isn't essential, but
Yeah.
like it's, communities rely on it, especially in rural
yeah,
communities.
honestly, I like at Target, I'm not looking to do my grocery shopping there. Like I'll pick up a thing or two if I'm already getting something else at Target, but like I'm not looking to get my bread and milk at Target necessarily. Speaking of Target, though, I was there today with a friend of mine, and literally between the two of us, barely anything in the cart. We spent no less than $200, and I mean, I got these hater blockers there though, and that was pretty sweet. But
How much for the shades?
Ryan, you owe me like half of your next dividend check, okay?
Yeah.
You're welcome.
Wait, I want to say one thing about retail though, like just in general. Ryan, why do you have so many retail businesses? Like retail is not a good market in my opinion in general. If you look at like retail, most of the businesses except Costco has not great pricing power. Like if you look at retail, if Target were to raise their prices by like 20%, there would be other retailers that would get more business due to that.
Before he answers, could you list off like Ryan? Because I don't know all of your holdings. Could you tell me what all the retail stocks you have are? And
Off the top, I'll pull up dividenddata.com sponsored today's video.
Because I know Costco and Target. I'm not sure what else you got in retail.
Costco, Target, Kroger. I'm pulling it up right now. Nike, I guess you can consider that retail.
I don't really consider Nike retail. They make shoes, they wholesale, and they go direct to consumer.
Yeah, Nike's not.
That's
it. Just Kroger and Target then.
Kroger, Target, and Costco.
Yeah,
that's it.
And Costco, I think,
even Kroger, like it's grocery more than like when I think of retail, I think you're buying your clothes and your household goods and maybe appliances and things like that, more so than your groceries.
Yeah,
I mean,
what do you think about? There was like the Ozempic drug, and then a bunch of like food stocks fell and retail stocks.
Let's go to the gym.
Oh, the weight loss drug or whatever.
Yeah, then a bunch of stocks fell. Like Coca-Cola fell, Pepsi fell, a bunch of like.
Is that actually the reason they fell?
Yeah, that's the reason.
You think that they're falling because of Ozempic?
That is the reason.
Then the market is stupider than I thought. Wow.
No, I swear that's the reason. If you look up,
I know. I mean, I'll take you at your word on that, but like that's crazy if people are selling out of Coca-Cola because of Ozempic. I mean, Ozempic, I think, is supposed to work by suppressing appetite. Is that correct, guys?
Yeah.
Honestly, I don't think enough people are going to use it to really put a dent in a company like Coca-Cola. Like, first of all, like probably not every country is going to allow Ozempic. and a lot of these companies are global. And second of all, I think a lot of people won't trust Ozempic because if it makes like weight loss or whatever that easy, there's probably a price to pay, and it's not a good one.
Yeah, well, the market's like very, they're very irrational sometimes.
They are. Yeah.
I mean, maybe with Coke, it actually could be a good thing because, like, after doing the valuation on Coke, it's crazy.
It's always going to trade at a premium, though.
Well, yeah, but like I got their price like $30 or like
Coke. It's on. So I came out. Yeah, I'm pretty sure I came out with something in the 30s as well back when I did it like 2 years ago, and it's on my watch list at 45 merely because I'm accepting that Coke will always be at a premium, and 45 is probably as good an entry point as you'll get. But I'll probably still pass on it for better opportunities because like that's still such a premium for pretty minimal surprises. You're not going to get like a surprise 25% return on your Coca-Cola stock every year. Buffett only got 11% over the last like 40 years on it, right? So
yeah. All right, so dividend, dude. I'm gonna let you and Fiscal kind of hash this one out. I'll throw in any facts or anything from either sides for questions or whatever. You have been very, very critical. Some would even say attacking his investment style, saying, quote unquote, he's buying cigar butt companies and falling knives.
Oh, no.
Would you like to have an opportunity to say that to his face while we're here and explain more of why? And keep that same energy, boy. I want entertainment value.
Oh, wait, my bad. I had a little interruption. Could you repeat the last part of that question?
What part didn't you get?
Most of it, actually, to be honest.
All right. You've been very critical of Fiscal's like investing strategy, calling it "quote unquote" falling knives
Okay.
in
Yeah.
cigar butt companies, and attacking him at a pretty aggressive rate.
Okay. Wait.
And
All right. First, I'm not attacking him. I'm attacking his strategy. It's a difference. I think he's probably a great guy. I don't know
say it
him,
how
but
it is. Say it how it is, in your opinion, and I'll let you two go for it.
well, I think that you're investing in companies that intrinsically are going down the drain. Most of them, like Walgreens that has been deteriorating. Paramount, another company that they've literally been getting destroyed by one show. They have one show that everyone watches on there. I think it's Yellowstone, and Yellowstone has been charging them insane prices because that's the only show people usually watch Paramount for. So you have that, and then you have like. Well, yeah, Star Trek, but right now it's mostly Yellowstone. Like I don't know if you've seen the news with Star Trek. Have you seen the news of Yellowstone?
South Park.
South Park's great. I like South Park, but
yeah. I mean, so yeah, like Paramount. I'm not saying that their financials are in the best place right this moment. Obviously, they wouldn't have cut their dividend if that was the case. I just think they have a lot of long-term value in their IP. And I think it's worth more than what the market cap of the company is right now. And I think that I'm in it at less than half what Berkshire is in it for. And I mean, if anybody here wants to think that they're smarter than Todd, Ted, Warren, or Charlie, be my guest. But I think I see the same thing that they do in terms of Paramount's value.
Yeah, you could be right. But I mean, you're looking for like a recovery or like in my opinion, it's a cigar butt. You're not going to get much out of it. It's literally just like a recovery. There's streaming businesses that are better than Paramount. There's Netflix, Disney.
A lot of the financial constraint on Paramount right now is because ad spend is in the shitter. I mean, any monetized YouTuber can tell you that their CPM is a lot lower than it was a couple years ago during the lockdowns and whatnot. Well, you can't tell us that, Ryan.
Top secret. That's been monetized like a month.
But yeah, I mean, the ad revenue thing hurt Meta, hurt Google, and it hurt Paramount especially hard because a lot of they still have a lot of live TV. Now, yes, granted live TV is not the future, but it's still the ads from that, especially with their sports, is a lot of their revenue still.
Yeah,
and so if ad spend drop, it's gonna crunch their bottom line temporarily. That's the thing. A solid company with a very temporary problem equals potential value. That's all. So it's not a cigar butt. It's not something that's going to have one last puff and then it's gone for good. Paramount Plus has 80 million subscribers, I think it was last time I checked. And yes, granted, only Netflix is actually figuring out how to be profitable at streaming somehow. But I think the other companies will eventually figure it out if Netflix could.
Okay. Wait. Yeah. Even by that classification, though, like your recovery, you're looking for like value in the recovery. Even by that classification, there's better companies that are recovering. Like in my opinion, the two that I really like that are recovering are Disney and CVS. Like those have gotten hit very hard, and in my opinion, those are like better companies that you could recover for. Like I mean, like Paramount, Crocs too. Of course, Crocs. I love Crocs. Crocs is a great business.
I mean, I don't have any problem with CVS or Disney. I think those are both perfectly fine opportunities. It's just, for me, Paramount was the simpler and more obvious one at the time. Disney is an incredibly large and complex beast, and I think it takes me a lot more time to be willing to commit to something as complicated as Disney, comparatively speaking, because the bigger the company, I think the more there is you have to digest and understand.
Do you want me to like explain Disney to you? Or,
I don't need you to explain.
Real quick, what are Crocs' margins right now, Dividend dude? Putting you on spot. What are Crocs' margins?
Not looking. I think they're about 25% bottom line margins.
We'll test them on that.
I think, bro. I didn't look. But Disney, in my opinion, is set to recover a lot. And have you seen they're doubling their investments in parks? And so all
surface level stuff that gets talked about on the Discord or that gets talked about by other channels on YouTube. I'm familiar with, the bullet points on Disney.
Yeah.
But have you ever seen the flow chart of like every single subsidiary and brand, etc. and like the interconnected relationships between them that make like the complicated web that actually makes up the corporate structure of Disney? Because somewhere in there, they're losing their margins. Their margins haven't recovered from COVID, and I'm having trouble understanding why. And until I understand that, like, I'm not going to bet on them to return. I think they probably will, better than 50% chance. The analysts agree with that. But, you never beat the market by going along with the market consensus either. So I need to understand it before I'll put money in it. That's all.
Yeah, the reason I think the reason, but their low margins right now is because their movies have been like flopping in the box office, and I mean, when they were like booming and they were releasing a lot of good shows, that's when their margins were best. So
they also were streaming back then, though.
Yeah, streaming too.
Spending a bunch on streaming.
I think either they need to cut off streaming entirely or like figure out a way to recover it. I think Netflix is going to win that battle though. But I think there could be multiple winners. I think Disney can be a winner in that. Yeah, they just have to figure out how to do it.
I'll say this: like, a company doesn't have to be the best at what they do to be a smart investment, right? Like, Coca-Cola and Pepsi both make cola, but even though I like Coca-Cola better, as a product, doesn't necessarily mean Coca-Cola is the better company to buy than Pepsi, right?
Yeah.
So, and I think with streaming, it's kind of a similar thing. You might say, hey, maybe Netflix is the better streaming company, but hey, Disney might have, pretty good streaming too. And they offer a lot as an investment potentially. And hey, maybe they're more worth it. Maybe the value is better.
Yeah, I actually think Netflix is a better investment. Not at current valuations, but overall, I think Netflix is probably gonna do like better.
If both of them were magically available today at a 15 PE.
Exactly.
Yeah, I probably agree with that, because Netflix, I think Disney has so much going on. Like, I mean, I think they've on the one hand, like, they're not too much into any one thing. So if one part of their business isn't doing great, they've got others to prop themselves up. But at the same time, some parts of their business super vulnerable to pandemics, apparently, right? And very capital intensive in some ways. Parks and cruises and such, those are pretty expensive operations to run, right? Yeah, there's so many moving parts with Disney. Like, I may get there eventually, but for me, Paramount was almost a no-brainer, actually. Like, it was pretty easy to like wrap my head around why the price was in free fall. And I think what the value proposition is going forward. And, I had like the little bit of validation that Berkshire is in it, pretty heavily as well, at a much higher price than myself, by the way.
I mean, Paramount, I mean, just me, how I invest as an investor, I like to see the economics going in the right direction almost all times. I'll say Disney's an exception to when I do that, but at almost all times, I'd like to see that happening. And if there's a reason for it, I'd like to know the reason so that they could continue to obviously go in the right direction.
But and like, on the same token, I think we've identified the reason for Paramount, and I think they're just as likely to have their financials improve as Disney. Because, I mean, Disney actually probably has a little bit of ad revenue, because they still have some live TV as well. So I think the ad revenue thing, when it turns around after the so-called recession, I don't know if we want to get into if the recession is a thing or not at this point, but let's say we get through the recession fear mongering and whatnot, ad spend goes back up. I think that's going to be good for all of them, really. Anybody that's in live television.
Yeah, Paramount's best year, by the way, for free cash flow was 2004. Ever since 2006, they haven't hit half of the free cash flow in 2004.
Paramount hasn't existed in its present form for that long.
Okay.
There have been mergers. So, like anything, if you go back too far, you're seeing a completely different company. The data feeds back more than like 4 years or something are basically useless, because Paramount used to be three different companies. Paramount Pictures, obviously their namesake now, CBS, and Viacom. So it's basically an amalgamation of 3 different major media companies all merged together. Not unlike Disney, how Disney now has Marvel Studios, Lucasfilm, Pixar, etc., right? Fox, all that. Paramount's a similar thing. It's an amalgam. In fact, most of the media companies that are publicly traded are. Comcast is the same way. It's it's got NBC and Universal, for example. Warner Brothers Discovery, an amalgamation. So you got to be careful when you look at the historicals on these companies, not to go back before they existed in their present form. And a lot of them are relatively new from that perspective. And so it's a little bit more reading the tea leaves, I think, than just looking at the historicals.
Okay, I mean, I could see. I mean, I guess I could see Paramount maybe recovering, but I don't. In my opinion, I don't like to try to invest in recoveries in general. They don't seem like the best.
Well, I think it's basically worth about what Berkshire paid for it. Like I think they probably paid about fair value for it, and they just got unlucky with the timing, and the price shit the bed. And I'm okay sitting and holding it, waiting for that to play out. And it's a pretty small position. It's not the end of the world if it takes a while to do that, or if it doesn't recover as well as I think it will. It's fine.
Okay. So what
investing strategy still cigar butts and falling knives?
I don't think Paramount's a good business. Like even when they were generating free cash flow, it wasn't great for them. And they've I don't think it's a great business. I still think it's cigar butts is mostly what it is, right? You have Walgreens in there as well. You have Intel in there as well, and those economics have been deteriorating. The business Walgreens is just like a worse CVS in my opinion. CVS just has more free cash flow generation, better acquisitions. They have a healthcare planning business that they recently bought out. Walgreens doesn't have these things, and Walgreens has basically just deteriorated in terms of theft, in terms of shrinkage, in terms of different things that's happened to them. Yeah,
I mean,
and they haven't been able to recover.
What makes CVS less vulnerable to that, though?
I mean,
CVS isn't less vulnerable to that, but they have more acquisitions.
CVS has Aetna. That's not
what I see in it.
I mean, if I was buying CVS, I'd be buying it because of Aetna, not because of the retail necessarily. Now, Walgreens, you say it's deteriorating. I mean, the vast majority of the problems you can point to and say this is what's wrong with Walgreens have been things that are probably within the last 12 to 18 months. Again, good businesses can go through rough patches. And I think before that, most people would have agreed, Walgreens is a pretty good business. And it just so happens that it's been a particularly bad 12 to 18 months for them. The market is perceiving that and pricing it at a steep discount to, I think, what their long-term value is. I mean, their normal earnings level, a lot higher than what you've seen recently. Now, the theft, that's a tough one. Like, I think a lot of that depends on, if the government will do anything about it. So that's definitely a risk. I mean, Walgreens is working on solutions for that with some of their stores, some security measures, as it will. And they've only been doing it at a few test locations. We don't know yet if that'll be worth the squeeze. But Walgreens also is investing in primary care, so clinics. Pairing up a clinic with a pharmacy seems to be a smart synergy for me. They have a big footprint. Walgreens is kind of like the McDonald's of pharmacies. They're everywhere, right? And if they can take advantage of that by adding an add-on to a lot of their locations, I think that's a good avenue for growth. Hasn't proven out yet, but there is an avenue for growth. Maybe not as good as Aetna, but there's some upside there.
You said something about great businesses go through worse periods of times and they could struggle temporarily. Don't you think it would be better to invest in a business like, let's say, Costco, where something like theft comes around, and theft really doesn't affect Costco at all?
Yeah, I could pay 50x for Costco.
They're not even. It's actually 35x. It's actually 35x.
All right. Right now it's 35x. Okay. Last time I actually looked at it was 50.
But don't you think?
Or I can pay like 4 or 5 times what Walgreens usually produces and just wait for it to get back to that level. And then the market will say, oh, you know what? Actually, Walgreens makes money. Huh. What about that? Maybe I should buy it again.
I don't see like theft like going anywhere. Seems like it's getting worse, to be honest.
I mean, what made it increase all of a sudden? Like, that's the thing. And do you think that these multi-billion-dollar companies are going to sit there and say, you know what? We're just going to let people thieve away all of our profits and not do a damn thing about it?
I think they're going to do something, but I think overall, their margins are going to be. They're going to definitely do something about it. If they don't do something about it, that's just dumb. I mean, you got to do something about it.
And you know, at the end of the day, like all of retail is going to have to adjust and do something about it, or you know, lobby the government to do something about it. But yeah, I think. You know, the theft issue has been some of the worst, probably in at least in recent memory. Like I can't remember, like, and I'm the old guy here, right? I can't remember a time when people could like literally just walk into stores and just take stuff with impunity. It's absolutely insane, unprecedented.
Yeah, that is insane.
But I don't think that can go on forever. I don't think people will tolerate it. But you know. Yeah, certainly that's a headwind for retail for sure. And, you know, Walgreens, unfortunately, has felt the brunt of that. They've had a few like bad publicity moments. The CEO is no longer. They had to pay out $6 billion for an opioid lawsuit. Yeah, a lot of
one more question.
A lot of nasty things have happened.
You didn't like it? Wouldn't Amazon be able to come out eventually with a pharmaceutical business that delivers right to your door? And wouldn't they be able to like crush all the pharmaceutical businesses around right now? I mean, I think that's possible. That
you mean pharmacy? I mean, pharmaceutical businesses are the ones that like develop the drugs and you know and distribute them to the retailers. Amazon, I think, is more getting into the retail side of things of delivering it to the customer.
Yeah. But eventually, they could. Eventually, they could get into the business.
How much they're being?
Are you saying they're going to compete with Pfizer or Walgreens and CVS?
Well, even they're being sued right now. I don't think the sue it doesn't really have much grounding.
It's a weak case, but like at the same time, you think the government, with looking at them now, at least, like the government's gonna let them do that?
Most likely, they'll have some issues with it. I think, but
in profitability.
My point is another thing. If you were to give like if you were to give someone what is Walgreens market cap right now? If you were to give someone Walgreens market cap, do you think they would be able to build a great, just as like if you were to give someone $19 billion, do you think they would be able to compete with Walgreens?
Probably not. I don't think so.
Why not?
Well, I think their footprint is too large to replicate with that amount of money.
What to replicate, like just building stores and pharmacies?
I don't think you could get the amount of stores in the amount of quality locations that they have built out and operational for that amount of money. No.
Well, I mean, this is what I mean. Like Walgreens doesn't really have like any sort of competitive advantage over other pharmacies.
I'm not saying they're a moat. So if you're trying to debunk them being a moat,
so eventually they could just get like kind of destroyed by other pharmacies or retailers?
I mean, any retailer, I guess, could get destroyed by other retailers, right?
Yeah, but so wouldn't you find it best to invest in companies that can't? Companies with like a competitive advantage over others, with pricing power, with like great qualities, monopolistic qualities that keep them around for 10, 20, 30 years?
I would say Walgreens probably does have pretty solid pricing. I think a lot of wholesalers and stuff want to be in Walgreens, right? Because they have like, what is it, 13,000 locations? I don't know the exact number offhand, sorry, but like I would say they do have a good amount of pricing power. I think they have a decent brand, like at least as good a brand as like Walmart or CVS or any other.
Yeah, you know what you're getting when you walk into a Walgreens.
Yeah, I mean it's like they've got a I think a pretty positive reputation. With
you're talking about Walgreens, you're just talking about it like it's like any old like retail, like it's like any like CVS or like
yeah.
So my point is like why would you pick something like Walgreens over like a greater business model, a greater like company. There's definitely better companies than Walgreens that'll probably do better over the next 10 years.
I own some of them. It's just, I thought that at the price Walgreens has been, it's been a compelling value.
I mean, I can't argue that if you could see it being a compelling value at the current price. I just think there's certainly like better businesses you can invest in than Walgreens.
Right. Like I said, unless you've picked the absolute best business that there is, there's always a better business. I'm just trying to pick a basket of, maybe a few dozen at most that make the most sense to me at the time. Right. Mm-hmm. That's all. It's pretty simple.
Yeah. Okay.
All right. Dividend.
I mean, I guess.
I want you to attack me in the same way that you just attacked Fiscal's investing style. So I've been.
Hold on. Before I think Fiscal's investing style is fine. It's unique.
That's a bit of a different sentimental change. That's a little bit of a change.
No, honestly,
I still think it's cigar butts, in my opinion. Right? I don't think it's good. I don't think they're great companies. But I think people have different ways they invest. If he wants to invest like that, he could go ahead and do that.
It's funny, but people want to quote Warren Buffett at me, but I think most of the people that do that, I share more positions with Berkshire and Warren Buffett than they do in most cases. So it's just kind of funny because it's like people quote Warren Buffett at me, but I think I probably, I mean, I share more similar investment ideas as far as the tickers that are actually in my portfolio than the average person. But hey, that's fine.
Do you have Apple?
No, I have a target price on Apple, and actually I know what Berkshire's is. Mine's a little different, but I'll buy it if it's ever at my target.
Okay, but do you think at current prices that Apple's going to do well over the next 10 years? If you bought it right now?
I think it'll probably more or less match the market because it basically is what props the market up in a lot of cases.
Okay, but it's beaten the market for year after year, for many years, and people have just said it's overvalued, just limited space to grow. And bought it.
25 years ago, they said it was going to go bankrupt.
Yeah, well, 25 years ago, it was a way different business than it is now.
Exactly.
If you look at it right now, it looks great, and I think over the next 10, 20 years, it'll continue to do great.
That's the perception now, is that it'll do great for the next 25 because it's done well for the last, say, 15 or 20.
No, I think it's because it's built an ecosystem of products, an ecosystem of iPhones, the Apple Play, Apple TV, many different things that all connect. I mean, their iPhone and you could see it right now with the pricing power they have with Google. Google's paying them to be on their platform. Search platforms are competing to be the default on their platform.
Hey, Apple's one company where I'll agree about the moat and everything, right? It's one of the examples in my video. By the way, watch the video, everybody. Plug. But at one point in time, IBM had a moat and was perceived as being just as invincible as Apple is today. Over 40 years, things can always change. And honestly,
I'm not saying.
And something can be great. All right, something can be great and also too expensive, right? I think I want to say we agreed on that earlier about something.
I'm sorry to interrupt, but I agree with you. Something can be great and not too expensive. Apple barely trades higher than the S&P 500 average PE. So would you say Apple's a greater company than the S&P 500 by a wide margin, or by a little bit? Because if you say it's by a wide margin, then you wouldn't be overpaying at the current value.
Well, it's funny because I said, what did I say? I thought it would do more or less match the market because, I think the market on the whole is also, overpriced right now.
But even if the market falls, Apple usually falls along with it. Usually it's priced not significantly higher. It's priced a little bit higher. And if you think it's a significantly better business, then one would say that you would invest in
it. Not if it's above what I think its intrinsic value is. I'm not going to, just because the market's also overpriced. I just don't see that as a good reason.
Well, I mean, people in 2012 said the market was overpriced by a wide margin. If you start investing in Apple or just any company, most companies in 2012 have gone up a severe amount. So overpriced usually is relative. In the next 10 years, you could say the market's overpriced now. It'll be probably a lot higher than it is now, even if it's overpriced.
Well, I mean, even objectively in historical terms, the stock market, the like overall market cap compared with GDP. I think they call it the Buffett indicator because Warren Buffett came up with it. But by that metric, it's at historical levels of overvaluation. What do you got?
Slow down.
John told you to slow.
My bad. I gotta get the points across, John.
All right, Dividend dude. I want you to bash me. Do what you did for fiscal. Just
Honestly, I don't want to be on here to bash people though.
recently.
That's not the type of person I am.
No, you know
I'm
what?
not here, like,
I think
I
he's
hear it
been
in the
perfectly
Discord. I want to
respectful.
hear it here.
I think he's been perfectly respectful.
Yeah, I'm not on here to bash people. I mean, I think there's different investing strategies. I think different ones do better, and I think different ones do worse. But that's opinionated. No one can predict the future. I can't predict that Apple's going to be great, but I could take a bet on it, which I am. And you know, that's my opinion. Every recovery play has a story, and you know, just because like you think Walgreens has a story to recover doesn't mean it will or doesn't mean it can. We don't know the future. I just don't think Walgreens is going to be a better investment in 10 years than a company like Apple or Microsoft or S&P Global. That's my opinion, you know.
I want so go after my portfolio. Go after my investing strategy. I've been hearing some slander. I've been hearing some cigar butt, some.
I think. Well, I mean, I think the NextEra Energy. First of all, I mean, I know you have a small position in that, but I don't think that's a.
I'll defend it a little bit. What don't you like about it?
First of all, I just don't like the utility sector in general, to be honest. Just like the whole sector's underperformed the market long term, usually.
I'll fact check that real quick.
And as well as that, I don't like cyclicality and like energy, like oil and energy. I just don't like the cyclicality of them. It's kind of like, I don't know.
Couldn't you say the same for a lot of other companies that you potentially own?
Yeah. Which ones do I own that are highly cyclical? I don't know. I own highly cyclical.
I gotta go over your portfolio again off the top of my head.
Yeah, I mean, I try to stray away from like oil and energy, to be honest.
Oh, I see. Okay, I get you. I mean, when you're talking about volatility, you know, utilities, obviously, besides this week, they're typically a lot less volatile. And NextEra Energy, I'll admit, when I bought it was not the best buy compared. It was like 2 or 3 years ago, with no excuse at the same time. But I mean, I still do have a bull thesis on it potentially long term, but I also have a bear thesis.
Yeah, I mean, we all like develop our bet. Like I've made plenty of mistakes. Like I have like videos of like what I like. You know, like you guys have known me when I first joined. I was very different than where I am now. Like Ryan, you've seen it.
Well aware.
So, you know, I mean, everyone develops their investing strategy. I think mine's gone under a lot of different influences, and right now I think I'm doing the best I can.
What other holdings don't you like?
I don't like I don't like a lot of them, to be honest. But I'm not gonna like say every single one.
Do it.
I'll say the ones I like.
Here. Do the ones you don't like.
Well, okay.
Do it.
Well, I mean,
I'll
you know,
the portfolio right now.
I don't even have. Okay,
I'll pull it up. I'll pull it up.
100%
Put it on screen.
I'm putting it on screen.
Okay,
Tell me the ones you don't like.
I like Microsoft.
Okay.
SCHD. I mean, you know, I don't have a problem with it.
It's good.
There's
good.
a lot of cigar butts in SCHD.
Yeah. I like Apple. Yeah. I like Starbucks. I like Visa. AbbVie. I mean, AbbVie's okay. They're not great. They're not bad. They're okay.
Makes them okay.
What makes them okay?
Yeah.
I mean, if you look at their economics, first of all, if you just take a look at like AbbVie's economics and like the different.
We're here. Free cash flow. All right. Free cash flow's not pulling up. A 3-year CAGR of 16.66%, 5-year CAGR of 18.3%, and 10-year CAGR of 13.64%.
Yeah, it's solid. I don't think it's bad. Okay. I think there's definitely better.
I will say too, to AbbVie, that could slow down.
AbbVie also, I think it will slow down because I think they've.
It will slow it down a little bit
and different stuff.
As big as it's been priced in, or it was at least. All right, continue.
Yeah, I think Target, it's okay. Vici, I like Vici.
Whoa,
I like
Target's
McDonald's.
okay. That's not what I heard in the Discord.
That's not what I heard either.
I mean, it's okay. It's not great. I don't think
what tier do you consider okay?
Probably like B or C, something like that.
Well, earlier it was C or D. I like.
I have a big smile
back.
on my face right now.
I think they'll recover. I don't. There's definitely better. Like I said before, like it seems like you diversify.
I've admitted that. I think. I mean, valuation's very important. I think Costco, it's probably the best retailer when you look qualitatively, but
All right. Well,
and it trades. Continue.
Johnson and Johnson. I think they're a slow grower. Probably.
Yeah, I
do
can.
Okay.
Yeah.
Coca-Cola, same thing.
Yeah.
3M, I don't like at all. I think they're going to deal with a lot of lawsuits for a while.
Yeah.
And I don't think it's going to continue to perform how it has in the past. Altria, I think it's solid, but I think the industry's dying.
With 3M,
overall.
going back to 3M real quick, what makes you think that they're not going to be able to perform how they did in the past? Because looking at their revenues, it's pretty much stayed like their actual business.
I think they're going to keep being riddled with lawsuits because of the long-lasting effects of the chemicals. I think it's not going to stop. But I could be wrong about that. But I actually do.
The earplugs are the big, like the ones that like have.
No, there's also like chemicals in like their main products.
So, to my knowledge, PFAS and earplugs both are settled matters now.
Yeah.
Or they came up with a number.
Yeah.
I think they came up with their final number, and it was billions of dollars, of course.
Not good.
Though I want to say it was looking a lot like, other than what they pay out in the dividend, it was looking like the payouts on the lawsuits were going to eat up the other like 40% or whatever their free cash flow. So that's not great for 3M.
All right, wait, Ryan. Before I'm kind of on a time press right now. I kind of like I actually do have to leave. It was fun though. I wasn't expecting it to last 45.
We couldn't get through all the holdings.
That's what she said.
Okay. Yeah, well, I mean, I think it's solid. I think you're over diversifying though, and I think there's better businesses than ones you currently own. Like you could definitely find better than Target, Altria, 3M, Kroger, Coca-Cola, UPS, NextEra Energy. Like I think you should invest more into companies like S&P Global, Costco.
I mean,
Apple,
I can agree there,
Microsoft.
but like, I just don't understand why I'd sell out of those companies right now. You know what I mean?
Yeah, I could see that too, but I think it also comes down to opportunity cost. I think there's a lot of deals right about now. I think there's good, fair valuations.
But wouldn't I be wasting out on the 3.5, 4 years of compounding that I've started with some of those positions that I built already?
I think you get more compounding in other positions.
But I've already started the compounding.
But I mean, I see. I don't. That's kind of like a tricky thing. I don't.
So here's the tricky thing. The average retail investor loses to the market considerably because they choose the exact wrong times to exit and re-enter different positions. And in most cases, they would be better just buying and holding on for dear life, except if it's like Wish.com or Oatly or Tattooed Chef. Yeah.
My major stance is that I just think that you should like buy and hold the companies long term that are the best.
I see.
That's literally it. That's it. That's all it is for me. Right.
See.
So I don't think you have like the best in there, but you do have good businesses. I think I've criticized a lot of them in the past, and there's reason for the criticism. But yeah.
What before you go, what happened with the Kroger sentiment change? I felt like that was very sudden.
For me? Oh yeah. I bought Kroger
besides it being retail.
I think like 7-8 months ago. And for the sentiment change, it's simply I think it's still gonna do good. I think it's still like a B, C tier company, just like Target. But I think that there's better businesses, and that's literally just it. I think I want to hone more in on better businesses. And I just want to hold the best of the best. And I don't think Kroger's that. I think there's definitely better. Does that mean I think they're going to do bad? No, I think they're going to do solid. I just think there's better.
All right.
All right.
Dividend Dude, where can the people find you before we hop out?
Dividend Dude, that's it. Just type it in. Probably see it.
Are we linking him in the description on this one?
We'll see.
All right.
You'll pay to see that.
All right. You guys have a good day, okay? It was fun.
Yep.
Good night.
Take it easy.
Wow, what an eventful stream.
Fireworks.
Unfortunate he had to leave right before I could classify him.
No, I feel like he chilled it down a little bit.
Yeah, I mean I was expecting a little more, unfortunately, with some of the talk I heard on Discord, but you know,
glad he kept it classy though.
Yeah, good productive conversation.
Yeah,
I've already expended all my energy on FC Canada over the last 24 hours, so
Jordan seems like he's disappointed with the lack of.
He's expecting more fire. Hey, I had the fireworks ready to go. I'm not gonna go out and tag him.
We need to do a finance YouTubers boxing competition. I think.
Yeah, we should.
Yeah.
All the illegal streams. All right. Well, you got let off easy.
I got let off easy. Yeah, for sure.
All right. Well, thank you all. This is probably going to wrap up the stream. We've had very good viewership throughout this, so it really does mean a lot. If you haven't already, make sure to subscribe, turn on post notifications. Tomorrow we'll have out our video of the stocks that we bought this week that are going to 10x our thesis and all that good stuff. So
if not 100x.
Yeah, you never know with our channel. Will we have the sunglasses on in the video? I don't know. But fiscal, you guys already know where to find our stuff. I've probably said it 1,000 times at this point. Make sure to like, subscribe, and of course do dividend stocks at drugs. And of course, cash flow is king. See you in the next one.